Let me just start by saying, should we care if banks basically contract? From a strictly economist's point of view, if the intermediation process, which banks have been courting the economy since their origination several hundred years ago, no longer serves a useful purpose, if we can obtain precisely the same economic functions by other, more efficient means, then one would have to argue that banks per se, or depository institutions per se, are of no particular economic value to the system. However, what we have in our banking system in general, and very specifically in a lot of different variations, and I would add in here the thrift institutions as well, is an extraordinarily gifted group of people who synergistically understand the financial process and the financial system in a way that would be very difficult to reproduce in another form. So while we might, in one sense, say that a decline in bank intermediation and the dissolving of banking institutions has no immediate, direct, visible economic effect, the breaking up of this type of knowledge base, this institutional culture, is, I think, detrimental to the economy. And as a consequence, if it is feasible to hold these banking institutions in place and to function in a manner which assists in the financing of the economy of Americans both here and abroad, then I think that's a very important value to preserve. Banking business, by its nature, is risk-taking. Show me a bank which doesn't take any risks, and I will show you a bank which has no economic purpose. As a consequence, you need to evaluate the context of bad loans from the point of view that they will always be bad loans. I frankly don't know whether or not a good deal of the poor lending, which in retrospect is obviously the case, is the responsibility of poor bank loan procedures or bad luck. I would say, as a guess, most of it's the latter. Even the best banking institutions that I'm aware of, those with the most skilled loan officers, those with the most extraordinary techniques to preserve the safety and soundness of the institution, have been visited, as many have been, with bad loans abroad, bad loans in the oil patch, bad agricultural loans. So what I can say for certain is that I know of a number of individual instances of which I am familiar, in which one would have to conclude that one cannot question the basic abilities of the people who were engaging in these practices. That is not to say that there are many others who were irresponsible, guilty of mismanagement, and a variety of other things. But I would be inclined to say that is far more that is probably a very minor aspect of this problem.
So you're of the opinion that banks will regain their footing?
No, I have no question about that. I think that it is the bailiwick of the Congress to construct legislation so that we have guidance on what it is we are doing. And now that the Congress seems to be desirous of doing precisely that, our focus has moved into this area, and we're now thinking in terms of the broader principles that are implicit in the type of legislation which the Congress now seems on the edge of considering.
What would have happened if we'd had revenue bonds as well as general obligation bonds for municipalities when the Glass-Steagall Act was passed? Do you think they would have allowed the revenue bonds under the same basis that they allowed general obligation bonds at that particular time? If so, why don't we change it to allow it now? And if not, what's the distinction?
Congressman, I really don't have a clue. It's an interesting notion. I frankly don't know what would have happened under those conditions.
Okay. Since we don't want to speculate on what the people might have done in 1936, what about now? The revenue bonds are, many municipalities consider them just as safe as the GO bonds and don't distinguish between them. They get just as good a rate of returns on the one as the other. Should we not make an exception if we don't repeal Glass-Steagall, should we not make an exception there and allow them to go to municipal revenue bonds?
I think that has got to be part of a much broader discussion which this is involved in. I'm not sure that I necessarily agree that there are no distinctions between
I didn't say that. I said some communities consider their revenue bonds just as safe as the GO bonds.
Oh, well, that may be true. The question is, are they? And that's a factual issue which I'm not in a position to make a determination of.
My cities tell me since we removed general revenue sharing that their revenue bonds are much safer than the GO bonds.
It's conceivable, sure. No, I don't deny that you can go to both sides of that issue, but it doesn't automatically, without looking at the evidence, I'm not sure we can make a judgment on that.
One last question, Mr. Chairman. You talked in response to Representative Siner's question about the moratorium. What would happen if we extend or did not extend it? You would like to see the moratorium cease as March 1st as per the agreement.
Yes, sir.
What are the risks involved of extending it beyond that point? Are we being unfair to the bankers by going back on our word, number one? Number two, what was presumed at the time that passed that we would take other action or not? Or in other words, was that based on the fact that it'd give us time to do something about the Glass-Steagall Act or other things?
Well, I don't know if it was about the Glass-Steagall Act, but it was certainly, as I understand the purposes of the Congress, was basically to sort of freeze things until Congress had a chance to look over the total structure of the banking system, which is what you're at the moment proceeding to try to do. I'm not sure whether or not it's an issue of being fair or unfair to the banks. My major concern is that it is undesirable for the economy in the sense that it builds up distortions if you keep that moratorium in place, which, as far as I'm concerned, are wholly unnecessary and inflicting cost on the financial system, which strikes me as a cost without any offsetting value. Let me just tell you very specifically where the real problem in my own judgment lies. If, for example, we did not have the federal safety net, that is deposit insurance, access to the discount window, the access to the payment system, then I would say there is no rational reason to have something which is, in a sense, a wall between securities, investment banking types powers and commercial banking type powers. The one issue that we have to be certain that we can affect is that the essential federal, quasi-federal subsidies which are built into the deposit insurance, which enables commercial banking institutions to borrow effectively with a government guarantee, as well as the other safety net characteristics. What we want to be certain is that subsidy, which serves a very fundamental public purpose, is not employed for other than commercial banking. So for those of us who are inclined in the direction, as I am, in tearing down this wall, we also have to be in a position to stipulate that, in effect, by so doing, we are not, in effect, allowing the investment banking powers which would accrue to be financed by federal guarantees.
So you are concerned in substantial part about the problem of unfair competition, a federal subsidy that would be essentially used by the banks to compete unfairly. I guess that is a little different from what I have...
Can I just substitute? The answer is yes, but I have a more fundamental issue.
Okay, please continue.
The same views that lead me to like to see a freer economy are those views which also makes me very much disinclined to extend federal subsidies. And what I don't want to see happen is that the subsidy structure underlying the federal safety net not be extended beyond what the Congress very specifically constructed it for.